And really, I think there's going to be different opinions coming from you, being investors both in US and Europe. So I'd like to start with Danny and just kind of think through, what do you think are the biggest differences and similarities that you could think of, fintech and energy tech? I know, you guys focus exclusively on, investing in energy tech, and so pretty much all of us. But what do you see from the industry, especially in the US, right? You've seen M&A all around the place. Amex snapping company, PayPal snapping a company. Do you feel there's any similarities between the two?
Yeah, thanks, Rokas, and again, thanks for having me on the panel here. So, just taking a step back, I think there's a couple parallels that I see between the two. And not being a fintech expert myself, I can still comment on I think a increasing amount of similarity in the path between both fintech and energy tech. First, both in sort of the banking system and these large energy systems, you have these very large, very complex, very infrastructure heavy incumbents, right? With your traditional banks and then your large utilities who have massive amount of deployed capital in the infrastructure ranging back for 100 plus years. And within the last 2 to 5 years, there's been a mass recognition of the need for hyper personalization and digitization, which I think the fintech space really captured over the last 5, 6, 7 years. I think the energy space is in the process of going through now. And then the last thing I would say is data is at the center of this, right? And what the movement in fintech has all been around sort of moving away from these very hyper complex incumbent systems into more kind of mobile native, personalized approach to the end customer. And I think that the new millennial customers who are the biggest buying cohort in the world now are looking to their energy bills and looking to their engagement interaction with their utilities and needing and requesting more personalization, more interaction. So I do think that there are parallels between the two, and it's quite an interesting place to be looking towards to see what's ahead of us in energy.
Nicholas, you're coming from a utility, right? So
yeah.
that this topic extremely touches you from one way or the other, trying to find new business model as part of your core business. What's your take on that? Have you found parallels looking from an investment standpoint when you were looking from a strategic point for your core business?
Yeah. Especially in the fact that, I'm working for utility, which is in a country where I think 75% of the country is banks. Luxembourg is renowned for that internationally, and we have a lot of banks, and we have a lot of flows in fintech since years and years, because we have the highest probably concentration of banks per square meters if you go in the boulevard here, and we have copied a lot of their systems. We have the same trading market, so we went to robotic trading, so we went to process automations because we needed to be better serving our customers. Our customers have been asking same. They have been asking for further interactions, better commercial relationships, and also because we started to have very closed-ended markets, and we're now peer-to-peer. We're coming to more open-ended markets, which are coming same types as the typical financial market. So we're using the same tools. We're using blockchain for clearing some transactions of ours. We would be using process automations in our core business. And we're also obviously looking for the same technologies to also optimize our trading operations, how we get flows of information, massive amounts of data. In our case, we got the smart metering, for example, in Luxembourg, and we got millions of data points that we were not using before. Like banks were not using some micro informations before, and it forced us to be better in this sphere. So we're very aligned. We're just way long years behind, but we are incumbents into the same industry, so we have to do the same. And we like from time to time to talk with banks here to understand how they did some transformations. Not to do exactly the same, not to do their mistakes, but the good thing is that they've done the drill before, so we can take stock of that.
And Julia, so you guys been around the block for quite a while as a fund. and you've been invested in one of the earlier companies there, and now has successful exits. And when you think about this comparison, you kind of seen through ups and downs on the energy tech sector and clean tech sectors per se. Do you think the similarity comes also in the business model essence to what I would say fintech lived through, and completely revamped the whole stack of infrastructure and traditional bank, and now that's exactly what energy companies are trying to do. What's kind of your take of that comparison between the two again?
Yeah, for sure, we see that. So so you see that fintech had a huge growth, particularly on software-based models, and the energy VC investments or energy investments have grown from less than 1 billion 5 years ago to almost 5 billion now, according to the International Energy Agency. But if you look at the breakup of that, then it used to be mostly investments into oil and gas and hardware, energy, clean tech technologies. And now it's predominantly software and electrification of transport, which is software and hardware, but there's a very large software and IoT component now. And that is the big shift that we're seeing. And that's why it's getting closer to the kind of fintech disruption that we've seen in the financial industry, that we're now seeing in the energy industry. Also, if you look at our own deal flow, in the past 15 years, about 10% in the beginning used to be software, and now it's almost 70% of our total deal flow in a year that are smart energy solutions, basically. So companies that have an important software component. We really see these business models disrupting the incumbent energy providers, both as challengers, like, for example, Zonnen, that we sold to Shell last year with a couple of other VCs. That really has a completely new, decentralized, democratized, and digitized energy business model that is really competing with traditional energy companies, and now has also been acquired by a big oil and gas company, Shell, which also shows the maturity of this sector of digital business models in the energy sector.
I'll definitely come back to this challenger idea versus comparison, because this is a very interesting topic, especially I think in European context, but also in the US. But and Amit, I think you're one of the most senior investors, having probably the longest experience in this sector. I think I want to kind of compare and take obviously a leap of travel time back to 2000 and more the hardware models. You think? I think this big shift of software, as Julia mentioned, what is being coined software is eating the world, and the question really goes: is software eating the energy market? And if you compare to the traditional energy models that came with the hardware, which is more licensing or as per se servicing model, do you think this is changing now to more software as a service type of model, more subscription? Do you think that is a shift that you're seeing now versus before?
Yeah, that's actually a very good point that you're making, and I'll come back to that, because we actually are looking at some companies who are trying very explicitly to do that. But as I was thinking about the broader question of clean tech and fintech and looking for what's common, so it occurred to me that there's some areas that are very common for sure. I think, as Danny alluded to in the beginning, they're both populated by large incumbent companies, either as customers or potential acquirers. And these are very large industries. They're both global industries. They're also very regulated industries, which also means that the problems that are being solved by entrepreneurs and investors they're big problems. They're large problems that have to be solved, and it's not like one solution solves everything. But it's still kind of, they're two different things. It's saying, okay, is the clean tech the next fintech? Is saying is a cat a dog? It's not. They're different. And so, but they're both animals. So I was trying to get at a higher level to see how I can think about the two. So the one thing is information. So if I think about in the fintech world, and by fin, I mean value, money, capital, you name it, it's a source of value. You can create it or source it. You hear about crowdsourcing companies. You can transmit it. PayPal, etc. You can store it, the traditional banking sector, transform it. You can convert foreign currency a number of different ways, or you can consume it. So if I look at these various functions, create, transmit, store, transform, or consume, I was trying to see, can I take that analogy and apply it into the clean energy tech world? Yeah, can you create energy? Well, the law of thermodynamics says no, energy is always conserved. So, you can use Einstein's equation and convert matter with E to mc squared and create energy, but otherwise energy is energy. But you can definitely transmit it, you can store it, you can transform it, you can consume it. So I was trying to look at that, and does that present new kinds of opportunities to invest in? And I think, but then you run into a wall because there are certain elements which I think are there in the fintech world because you're dealing with information. There's a great deal of networking effect. And it's also, whereas the energy world is a real world, a physical world, in some ways, the fintech world is, I wouldn't call it imaginary, but an imagined world because human beings have created that. So, there was energy and matter when the universe began with a big bang, but there was no money at that time yet. So these are different things. And so I think at the end of the day, it all comes down to labels, what's included, what is not. And it also makes for good provocative panel discussions to get people to think about it. But at the end of the day, you're either an entrepreneur who's trying to create a business, an investor is trying to make money. And you're right, in the fintech world, you've seen explosive growth and a lot of value created very quickly. And people are saying, gee, can the same thing happen in the energy tech side? And my gut feeling is that it's not going to be the same kind of a thing. There'll be good returns, there'll be good companies, but it's just fundamentally very different. It takes longer, it takes more capital, etc. So I'll go back to the original question you asked about, can you move from the hardware to the subscription?
Yep.
So I think you can. And so, for example, we've looked at some companies that use monitoring of air quality or water quality or even power quality. They have excellent meters, they have hardware that sort of captures it. And they try to migrate to, instead of me selling you hardware, I'll keep the hardware and I'll just give you peace of mind. Your water quality will be good, your air will be good, your power will be good. And to migrate to subscription services, you essentially provide assurance to the consumer that this is going to be done. I think this is an example of how you can move away from hardware and real productization into the software service model. So I think these kind of models will migrate from one sector to the other, and people will look for, hey, what worked here, what was really good, and how can I implement that?
Absolutely. I think just to kind of reflect on what you said, I think we're definitely on the white side, not the dark side of things, comparing fintech and clean tech. But coming back to your comment, I think this is calls for a broader discussion. I think it's certain that we will move to a software model. The question is really the construction of the industry as per se, and I think splitting the two, like B2C question of the neo sort of challenger utilities and the B2B question, just maybe briefly before B2C, touching on B2B, I think we are moving, but we're moving very, very quickly. One of the big, I think, questions that everyone is asking is like this, why traditional VCs are a bit slower to pick up on energy stuff is the B2B cycle. It's still damn long, and despite that the companies are trying to reinvent and create this enterprise SaaS let's say layer, it's very slow to adopt. What are your thoughts from like your learnings of investments, and what do you know? What can we do as an industry differently, or how we as investors could push like the corporates or the B2B users to use it more as a SaaS, as a service, so sort of software as a service model, rather than trying to do pilot and then buy the licensing and not being sort of like pushy and like, I don't want to pay your monthly subscription. I want to pay all in fee and that's it, buy, which doesn't work for us as investors in the long term in a way. What are your thoughts? I'm not going to pick on any of you. Just throw it there. What do you guys think?
Oh, maybe.
It's a really. Oh, go ahead, Julia.
How we get this? No, maybe just to briefly start. So we have been investing in the energy sector since, for a long time, since 14 years. And I agree with what you're saying. So the energy sector is generally much slower moving than for example, the financial sector. So especially hardware companies are very difficult for typical venture capital funds with a 10-year lifetime to invest in, because it generally does take a little bit longer. But even if it's a software model selling to energy utilities, sales cycles are generally long. So there are different ways to go about that. Either have real enterprise software solutions that are in the core of a utility's new business. We see that with a few companies that's happening, that they are really offering data management solutions that are really in the core of the operations of an energy utility. And then at some point they have to use it. And the other option is to sell something that's very quick and easy, like a SaaS solution. And really the third option is not to sell to slow-moving energy utilities, but to compete with them. So to sell to I'm not talking about Encivo.
But that's exactly the point. That's what happened like when fintech got really moved by B2B SaaS, when challengers went and ate their lunch. Suddenly you realize, okay, my stack doesn't work. We need to reinvent the whole wheel. And then suddenly goes off the acquisitions.
That is what we've seen with what I just mentioned with Zonnen, for example. They started competing with energy utilities, and then the energy utilities were basically too slow to see that and to acquire them. So it was a big oil and gas company that is now growing the company very fast inside. And we see that happening more and more often. So there are a lot of examples of those challenger new utilities like Bulb and Octopus in the UK, Van de Bron in the Netherlands, Greenstone in Germany, Equateur in France. They're all digital and green. They're built as new, more efficient and lean companies. And the big utilities have had real trouble fighting them off.
Danny, what's your take? You were just trying to say something before.
Yeah. Well, I think Julia is exactly right, and so I just had a couple of things. First, from our foresight in the U.S., we have more of a regulated nature of our utilities, right? So most of the utilities in the context of the U.S. have sort of a what we call regulated monopoly in the construct of their local geographic footprint. Where their returns are all driven by deploying CapEx, right? And so for the longest time, the reason why the one-time license software application to put on-prem was preferred was that you could capitalize it and then put it into the rate base. And I think part of the struggle with the movement towards pure SaaS is there's a little bit of regulatory uncertainty of how to account for those dollars and whether it can be capitalized or not in the construct of the regulators. I think we're moving towards a world where regulators are getting more comfortable with that model, but again, it's been an issue in the past. And then the last comment I would make too is in the U.S. there's 60+ million homes who can choose their energy providers, and that's where we've seen these digital players start to manifest. And it is a significant threat to a lot of the existing utilities, and the mirror that you can make within the fintech world is just for the longest time utilities had two things on their menu: electrons and gas molecules, and today you need to and you must offer additional services, whether it be clean energy, whether it be additional smart home devices, whether it be demand response or other value streams. There just needs to be a service or a multiple item menu that you as a utility can provide. And I think that's what the digital players who have come up, in Europe and again some in the US have really understood, which is a really interesting thing to be watching over the next 3 to 5 years.
So Nicholas, coming to you. So why is the utilities are so slow to adopt the software model? What do you think why is it? Why is it still so long? I mean, it's been like that for ages, but what's your, from internal standpoint?
There's two bits of our business. I think our company has the opportunity to represent both. I think if you take from the bottom line, the physical delivery, because it's need. I mean, the difference with fintech is that you have a physical delivery, which is linked to constraints of pipes, constraints of grids. And this one has been always hardware-driven, highly regulated. And if you see how the regulations are moving in that direction, 10 years ago, you would look at the regulations in Europe, you would look at it today, and you will see that it has completely changed. And probably there's a lot of numbers of now transcriptions that there is to be national laws and regulations that are still to happen. So the first thing we have is from a distribution. Then obviously that doesn't prevent us from being more customer centric. I mean, we've looked at that digital business model 2 or 3 years back. Obviously, it is always a different perspective when you're entering in the market or when you're defending a market or dominant market share. Because when you defend the dominant market share, actually you feel less the need to innovate than somebody who needs actually to earn from his living. You sit already on a large customer base. The banks had same. If you take the parallel, they historically had grown a large base, and the churn has been historically low until some people were shaking the tree. And I think it's good for us. I think it's good for the industry that there's new players in the block. We obviously, as a utility, we look on the outside. We took early on the decisions to look for solutions to partner with, because we can't do everything in-house, and we can do the transition from here in. We need to people from the outside world. This is why we do VC investments. We do both partnerships and investments for that exact purpose, because we are unable internally to innovate sufficiently. We do innovations. There's a lot of things we do in-house, but there's a lot of things where we lack expertise. Obviously, we are still very focused on the historical business, so we need to bring fresh blood in, and VC for us was the way to do. But it's good to see competitions. I mean, in our case, we have gone pretty well about that, but I know in certain countries, like Julia mentioned in the UK, if you look at the top 6 to top 8 companies there and how Octopus, Ovus, and others have done there, you will see what can happen if actually competition starts to hardly kick in.
And that's an interesting. I basically want to leave this B2C discussion for the last part of our discussion. So it feels for me like Mark Twain saying, history does not repeat itself, but it often rhymes. And it feels like fintech started from UK as the most liberal market, went to the whole Europe, became passported as such, and now they're finding themselves in the US. Revolut, for example, or N26, Monzo, and alike. So Octopus, Ovo, first $1 billion companies out of UK, again, expanding in Texas, for example, with Bulb as another contender. It feels like it's very similar narrative in a way. However, what I feel is that, energy is way thinner margin business from like the B2C perspective. And what I want to kind of touch as a discussion point is, so do you feel there was a great narrative that I found yesterday, as one of the Andreessen Horowitz partners said, every company will eventually become a fintech. And why I'm putting this out there is that, do you believe that in order to gain and make business profitable, these challenger utilities going to have to enter something that is not related to Electron, insurance, e-commerce, other business models, how they can monetize, DERS, obviously, distributed energy resources, demand side response. What's your take for them to make business there? Because I think from an OpEx perspective, it's not enough to just be lean on the operational side. You actually need to have some other extensive business models on the B2C side. What are your thoughts on this?
I would think first, I think the most naturally connected to a business is everything connected to demand response, because it's how you turn the electrons and to cut it short, how you can connect your trading rooms with your end customers directly. That's the idea. At the end of the day, we have, as utilities, we have, depending on which you talk to, you will have bits and pieces out there, and at some point in times we will line up the entire chains. For some customers we do, but not for all of them. And I think that's the easy way. In our case, we started to expand that. We started to expand everything that's around the electrons. I mean, doing operational efficiency for some customer segments, doing some incremental improvement and support on others. We started to work away from this. We still have on the electrons, but it's important for utilities now to become more, when I say customer-centric, is on the way we interact with our customers, but also on the way we can address issues that are indirectly related to the electrodes. I mean, when they talk to process efficiency, at the end of the day, somehow it's linked to our business. I mean, it's not directly linked, it's not directly physical delivery, but it's also still linked to it, because actually, if we have experts in the domain, we could use them too for that purpose and partner with specialized companies to complement and so on. So the area for us with the demand response, I think, is a wider topic for utilities per se. And then above that, there's all the things like going further on. I don't think we're going to go to insurance yet. Because it's still too far off. But the more we grow depth of relationship, and we started to have that in different formats, the more we start to get customers kicking us in saying, hey, can you help me with that? And then that starts to add another layer of service.
Amit, anything to add?
Yeah, so I feel I kind of very much agree with what you said. If all the industry is doing is to give you a utility commodity product at a lower cost, people say that's great, but my God, I can't get excited about that. I think instead of just making it cheaper and more efficient, you got to offer something new, and that cannot be done. And that's where technology, I don't know how it's going to do it, but that to me is the real energy tech, which enables, whether it's in the business world or the consumer world, new kinds of functionalities and capabilities and services that cannot be done elsewhere. I think that's really what drives growth and drives value. Now, whether that gets done by utility companies who are already having, or whether it's done by new startups who grow that and at some point become a threat or become a complementary fit, it doesn't matter where the starting point is. But I think the industry succeeds if it can do more than just lower costs.
Yeah,
I agree.
So the last comment I would add, sorry, Julia, is just the heads of these digital up and coming energy providers and energy utilities are quite smart. And as you look at sort of just the fundamental unit economics of the business, it is really hard to get your customer acquisition costs low enough that you can make strong margins on just providing a commodity business, right? And so, each and every one of these leaders are looking at their unit economics and saying, we need to layer on additional value here to drive our unit economics to an area where it becomes attractive for investor, but also ability to run the business. And I think that's also at play here. That just getting the fundamental economics to work out, you need to start thinking about creative solutions and other options on your menu besides just a commodity.
Absolutely. So I think we're running out of time today. I probably speak about this topic for hours with all of you guys. I think what's beautiful, I think what Amit put, it's the dark side and the white side, of things. I think when you go to dig deeper, fintech is something that is created out of thin air in a way, because humans actually invented money, but energy is everywhere. So on that sort of note, I think we're in a very, very long game, and I think the patience is something that all as investors we got to have high levels of. But as I see, everyone is quite excited about the topic, and I think the timing has never been better and right. Even in the wake of this COVID pandemic, which puts in even to bigger perspective. So thank you everyone for joining today. And we'll have to continue this discussion, and I hope to soon in person. So thanks everyone for chipping in into this.
Thank you very much.
Cool. Thank you, Julia, and the guys for sharing your experience. It was interesting and really insightful for sure. But before we move on, we actually have some poll information coming in from the audience on the topic. So basically, there are only two answers of what our audience thinks, which are the sectors that are the most exciting for investment in their energy. So basically, what they think is hydrogen. So 65% of our audience has answered for this one. And then the runner-up is e-mobility. And I for sure agree to them. So let's move further. We are actually moving quite fast to the ending of this whole first day of Energy Tech Summit. But before we conclude, I want to give a final shout out to our next session, which will be moderated by Thomas Kemptis of Contrarian Ventures, who joined us earlier today as well. Thomas will be moderating the fireside chat with Darius Daubaras, who is the corporate finance executive at Aramco. And both of them will be discussing the weaning of fossil fuels. So I for sure am really interested, what are the common exit strategies for this one? So without any further ado, folks, the stage is yours.
Thanks, Maria. And hi, Darius. It's a pleasure to have you here.
Thank you.
Live on air.
Thank you. Exactly. I just add, problem that, besides the Aramco, I also represent the greatest Lithuanian energy company now, sort of in the market, for the IPO, which just started today. So
exactly.
I'm
We've been hearing a lot
part of the
about
supervisory board.
Today.
Exactly. So Ignitis Group. So we have Aramco on one side and we have the Ignitis Group on the other side. So it's a big of duality, but yeah, we can chat about a lot of that.
Exactly. And actually some other roles as well, not only those two that you represent. But
exactly.
Anyway, I want to kick off. It's a final chat. It's a fireside chat. We really excited to have you on board, Darius. Appreciate the time with us. Super stoked for this session and want to cover a bunch of topics. We only have 30 minutes, so hopefully we can fit in so the listeners can really get the grasp of your career and your views on the macro in general and the industry and the shift and the transition. So Maria mentioned a few things about Darius. He's a super experienced executive, been in the banking industry across, since early days, across Salomon Brothers, Merrill Lynch, JP Morgan, BNP Paribas, multiple roles. Then he moved, I think, 5 or 6 years ago, he moved to Saudi Aramco, a massive conglomerate, which was still private back in the day. And I was really tasked with taking it public. It's a gigantic role, a gigantic challenge. But as we've seen from the share price today in the market, you have 2.1 or 2.2 trillion. It is the largest company in the world by market cap. So I think the challenge has been succeeded successfully. If you could just talk us through some of your experiences there, how did you really manage to do this? What did you have to go through, and through the learnings you've had?
Yeah. So I mean, obviously, that process, if we talk specifically about the IPO, it was a very long process, and different people were involved in different stages of the process. So my role was more at the very beginning, actually, when the Aramco just contemplated of going IPO. So it was the feasibility study that was prepared inside the company with help of some of the banks and consulting companies, and presented all the way not only to the senior management of the company, but all the way to the government and obviously all the way to the Crown Prince's office. So all that information was presented in terms of the attractiveness, what sort of valuation, what sort of structures the company could do. And as you can imagine, at that point in time, the company was still sort of decreed by government from the previous time, so it didn't have the proper stock holding structure. It had to be reorganized. Then the question arose whether it's a part of the company that could be IPO, and this is a company that has a lot of businesses in there, downstream, upstream, obviously oil and gas, but also power generation, number of JVs that could be also grouped and then taken public. So a lot of these structures were looked at as potential IPO, but then obviously the ultimate decision was made to do the IPO of the whole company. And that's kicked in even before the IPO, probably 2-3 years down the road. And then the process took about 2 or 3 years to reorganize the company first, to prepare it for things like financial reporting, to do it properly, strategy, of course, streamlining number of functions in the company, get it ready for the market, obviously properly explain the story of Aramco, and put it in the market. So I didn't participate in the last stage because it was already the big banking syndicate, and obviously the bankers were in effect leading the process at the time. But for me, the fascinating part was initially looking actually at that feasibility study, which actually made actual decision at the end of the day in terms of to pursue IPO and which structure. And that was very high, sort of fast-paced environment for 3 to 4 months, or even more, I think, when we had to prepare this sort of big groundwork, in effect, for understanding what is the feasible option here for the IPO. And eventually it came out to be the largest IPO. Obviously, a lot of effort in there. went in there. There was a lot of considerations for international listings, then it sort of was decided to do it on a domestic listing for different reasons. But eventually, yes, it was the largest company. And as you know, recently there were some interesting movements in the market, especially with tech stocks. Apple became the most valuable company, and then sort of Aramco again kind of fluctuates. So it's there still, but obviously with Apple there and with some other big companies right behind it. So it's a very interesting theme, right? You see the weaning ourselves of fossil fuels. We're seeing this big national oil company, which is by far larger than combined a lot of other companies in the world in oil and gas. I'm talking about the Exxons, BPs of the world, all of these, and then at the same time, it's almost the same size as some of the tech companies like Apple, right, or potentially, Amazon and Microsoft might catch up eventually as well. So it's very interesting. But it's still a big legacy. It's still a big dominating player in the industry, in the energy industry. And we can talk a lot about also, these trends, what's happening, how we see the fossil fuels going forward, how the renewables is playing part, how is the world changing, and so on. There is a view here as well, how that company views the world, but also, my work with Ignitis as well, very nicely sort of puts me in the forefront of some of the renewable discussions. But not to digress, yes, IPO was a very interesting project. It was very complicated. It was in a different market. The company that was not ready at the time for IPO, but it got ready in time and done a successful